when smart money is attacking liquidity, like below, above this high here, right above this high, would be buy stops. Anyone that would want to view a run higher than this high, they would be buying on a buy stop. So buying a breakout, which many times in London is a mistake. Or for those that went short from this high or just after it, they're going to put a protective buy stop there. So above this level here is a measure of actual real orders in the form of buy stops, which we call buy side liquidity. So you can see how the market randomly, I say that facetiously, obviously, this high here, they run that, but it spends a little bit of time up here. What's it waiting for, by the way? What do you think it's waiting for? I mean, it's already traded into the 5-minute premium fair value gap. It's already traded to the mean threshold here. What's it waiting for? Time. When does the price run really begin? 3 a.m. What did I teach you? There is a pattern that repeats that's algorithmically delivered. It runs on a macro. That means it's going to happen every single damn day. It won't miss a day. It won't call in sick. It's going to show up every single day between 3 o'clock and 4 o'clock in the morning, New York local time. That's the London session, silver bullet. It's going to occur in the morning, New York session, between 10 o'clock in the morning and 11 o'clock, New York local time. And it's going to form, I gave you now 2 of them in the afternoon, between 2 o'clock and 3 o'clock, and 3 o'clock and 4 o'clock. So you have 2 chances to catch up in the afternoon between 2 o'clock and 4 o'clock. You have 2 chances to find this pattern. And for the London session today, we see the premium. It reaches up into it here. The price run really begins at 3 o'clock. Here's that 3 o'clock candle. What is it going to reach for there? Initially, it's going to reach for the sell side, resting right below here. And I don't want to add more annotations like this one here because it kind of like makes the chart a little bit more cluttered than I like it to be. So this one here is a bearish breaker. So we have high, the low prior to the higher high. That's what we're framing. So I'm showing you that wick there. Why am I showing you the wick? Because look to the left of it. What do you see? What's that right there? What is this? Fair value gap. What kind? Buy side imbalance, sell side inefficiency. So how do you know what kind of fair value gap it is? If it's an up close candle, that means it's a buy side imbalance, sell side inefficiency. If it's a down close candle like over here, it's a SIBI, sell side imbalance, buy side inefficiency. You're going to be anticipating the market wanting to go back down through between this candle's high, that candle's low. But if we have a breaker in there, we want to have this level also annotated, because on this side of the curve, that means the market goes up to take stops to go down. On this side of the curve, but past or to the right of this low, which is a bearish breaker, we have to include this range, extending it forward, because this will act as an inversion fair value gap. So once price trades above this short-term high here, there's buy stops resting right above that, because there's always liquidity above an old high and below an old low. The market's always constantly going up and down for 2 reasons, only 2 reasons. It's going up to an inefficiency up here, this down close candle. What happens inside this down close candle? A short-term high forms here. So there's buy side listed right above that. Does it run into that? Gets real close to it, but doesn't take it out, does it? This upper portion of this down close candle, that is the premium range of this inefficiency. If I'm looking at a fair value gap, if I'm looking for a fair value gap that's part of a balanced price range, as I've been outlining here, I don't really want to see it trade to the upper portions of it. I want to see it remain open. Oh my goodness. ICT just taught me how to look for inefficiencies that should not completely fill. Yes, this is one element of it. This shouldn't fill in. If it's going to be bearish, if I'm expecting it to be bearish, if I want to see price run for sell side here, potentially trading into the 15-minute discount, buy side imbalance, sell side efficiency, consequent encroachment. This upper portion, I want to see that stay open. So the market does in fact trade up to the 15-minute time frame bearish order block mean threshold, which is that red level here, and trades into the lower portion of this 5-minute premium fair value gap. So we're blending a lot of different things here that builds a narrative. It's not just me looking for one fair value gap or one order block. It's a lot of things coming together, coalescing, and then when does it really run? At time of day that the algorithm will start spooling. Spooling is when the price does this type of thing here. It starts running in one direction. This back and forth stuff, that's not price spooling. S-P-O-O-L-I-N-G, spooling. This is not spooling. This is spooling. When it starts running one directional to a inefficiency, meaning like a fair value gap here, or the one that we framed on the 15-minute time frame, the mean threat, the consequent encroachment of it. If price runs for liquidity or in an inefficiency and it's directional, that's price spooling. If it's doing it in the context of upward delivery or moving higher, okay, that is buy side delivery. That means the price is running higher, offering buy side, drawing to a liquidity of buy side liquidity. If the market is dropping, that is sell side delivery, aiming for and targeting sell side liquidity. Relative equal low here to here, and then we have relative equal lows over here. So when the market breaks below the short-term low here, look at the 5-minute chart here. Let me just move this out just a little bit. Okay, do you see anything inside this 5-minute breaker low? Just the low of this new gap, which we would want to see do what? Stay open. Why would I want to see that stay open? Let's drill down to the lower time frame. Drop down to a 1-minute chart. We'll get a little bit more detail here. Before I do it, there is a 5-minute discount buy side imbalance, sell side efficiency here. Almost had to go back to this chart. See this inefficiency right here? This is inside of what? That 15-minute buy side imbalance, sell side efficiency. So in the upper portion of that, above the 50% of it, let me show you here. Watch. 15-minute time frame. This inefficiency right here, from its 50% level to this candle's low, inside that area right there, there is a 5-minute gap right there. That's what I'm framing there, okay? And you can see how the bodies are respecting all that. Now we just recently, right now, traded down into the low, what it's referring to. Let's drop down into a 1-minute chart. All right, so everything I've mentioned so far is we trade up to the buy side here. This is the high in the 5-minute breaker. So inside of that range, we're seeing this back and forth price delivery. This candle here, and then we finally get the run here at 306, drops, trades to the low of the new day opening gap, and here's the high of the new day opening gap. New day opening gap is the difference between where we close at 5 p.m. New York local time, and then we reopen the session trading at 6 p.m. So there's an hour break where there's no trading for index futures. So inside that 5-minute breaker, why is this a breaker? Because we have a high, the low, and the higher high. This down close candle right in here is what's being referred to as the bearish breaker for the 1-minute chart, but we're framing on a 5-minute. And remember, we had that gap, which would act as what? An inversion fair value gap, which is not here in the chart. I want you to do that in your chart, and you'll see how it amplifies what I'm about to show you here. Now, if we're anticipating the likely draw to a discount 5-minute buy side imbalance, sell side efficiency fair value gap, that's this levels here I mentioned, or maybe drawing down into that 15-minute time frame discount, buy side imbalance, sell side inefficiency, consequent encroachment, the midpoint of that 15-minute gap. Look at the bodies where they're coalescing at. Look at that right there. Isn't that interesting? And look what price is doing right now. So the market, while up here at 3 o'clock, that candle right there just perfectly touches what I teach you as a bearish order block, which is absolutely not a fucking supply and demand zone. It's not. It has absolutely nothing to do with that. Okay, that's nothing. This level is a specific price level. It's not a zone. It's not something random. I'm not plucking it out of my ass. It's really going to be there in the chart. It's really going to be repeating. The phenomenon repeats itself all the time because it's algorithmically delivered. That means that the markets are absolutely 100% controlled, and you should not be fearful of that. When I say things like inside of the 5-minute bearish breaker, right here on this candle at 307, what's occurring? The market's trading up into the 5-minute bearish breaker, which is shaded in this shaded area here. It's trading to the low of the inversion fair value gap that you're going to draw from the 5-minute chart. It's not in my chart now. That's the interactive part for you to put in your chart. It trades up to it here, and this down close candle right there. But ICT, look, it has that big wick. I don't give a shit. That wick right there has no bearing on what it is I'm talking about. The down close, I'm sorry, the up close rather. I said that incorrectly, sorry. The up close candle is a bearish order block. So that up close candle, when it's trading to it here, there's two things going on the 1-minute chart right there. Two things are occurring. It's trading to the breaker and inversion fair value gap on the 5-minute time frame. And on the 1-minute chart, it's trading up into a bearish order block. So when you see folks out there saying order blocks are just engulfing candles, that's horseshit too. It's nothing to do with engulfing anything. When the price is in a sell side delivery, okay, in other words, at 3 o'clock, the price starts its run and the macro begins seeking sell side, which is right here, and then aiming for lower sell side liquidity, which is below old lows or singular low. Every single time the market creates a up close candle in that sell side delivery price run, in other words, you're calling it a trending market. This is not a trending market. This is just a market that's declining. So that's why I don't use those terms, trending, because price swings are not trends. They're not to me. They're price runs. So if I'm expecting and anticipating price running to lower targets into a discount, either for the purposes of going to a fair value gap that's lower than market price, or to a low or relative equal lows for sell side liquidity, either one of those scenarios will provide me the context to anticipate lower prices. While I'm watching price, if I see something like this where we open, we trade down, and we rally up like this, if I'm short, I'm not freaking out over that. I want to see how we see the first up close candle when sell side begins its delivery. Because once we get our price run here at 3 o'clock and we snap below that candle that created it, what kind of candle is that? Is it up close or down close? Up close. So when we break below that, I want to see when price starts to run, we're in an area where I anticipate what's the inversion fair value gap expected to do? Create a resistance factor in price. It should accumulate more shorts. It should offer smart money the opportunity to get in and add, or like you see me many times do, pyramid more short positions in an existing short position. Our next up close candle is this one. Does it respect it? I don't know. What does it do on this one? Does it bump the bottom of it and run lower? The next candle? Yes. But you're looking at this and saying, but see, I got ICT by the balls right here. Here he is. He said that the silver bullet every single day it happens between 3 o'clock and 4 o'clock, between 10 o'clock and 11 o'clock. and 2 o'clock to 3 o'clock, and 3 o'clock to 4 o'clock. There's 4 opportunities for you to quit your fucking job, and you're worrying about everything else in the world about trading and who's doing well on social media. Stop. You're missing these opportunities because you're not focusing. You have to look at this price action in the times I'm telling you to study it, and you will see exactly what I've said is the truth. It's not made up. It's not contrived. It's not mythology. It's not animal patterns. It's not anything but the truth. Because of the framework that is outlined to you here. What time frame is this? What's up here? The 1 minute chart. Okay. What I'm about to show you is going to make some of you uncomfortable because you either don't have access to these types of time frames or you're afraid of them. You think that they're going to do something that would be alien to what would be expected on higher time frames. Some of you would look at a 1 minute chart and say, okay, yeah, I trust a 1 minute chart, but I could never trust a 30-minute or a 30-second chart. 30-second chart's just too fast. No, it's not. It's the same price. It's doing the same thing. If you put a 30-second chart, a 5-second chart, a 1-second chart next to an hourly chart, the same market price is being reflected on the hourly candlestick that's going to be shown on a 1-second chart. You just don't know how to read price. When you introduce these elements of understanding where price is likely to go, where else is it? What's this level right here? The new day opening gap high. And this level here. New day opening gap low. This up close candle is in what portion of that range? The premium side of it. In other words, it's from between this candle's, I'm sorry, not candle, but this level here and this level here. Split that in half. Right here. So this up close candle is in the premium side of that new day opening gap. If we're bearish, do we want to see it trade back to the premium end of that once we break below halfway, which is here on this down close candle right there? Once it goes down halfway between new day opening gap high and low, what are we seeing? We're seeing the market break down. We're seeing proof that the algorithm, the thing that actually controls price, and I know some of you don't like to believe it, can't believe it, won't accept it. I don't give a shit. The point is it's going to keep doing it. It's going to do it every week, every day, and it won't stop. And it's better for you to learn how to see these things because it will make your trading better. Whatever it is that you're using, it will make it better. It'll help you ferret out the ones that you're losing your ass on. So right in here, in this little area here, we're going to look at these two, well, this little range in here. You can already see there's a highlighted shaded area here. I have that so that way you can see in contrast. You're probably going to hear Piper, which is one of my puppies. She's next to me snoring, so just if she's heard, just know that there's nothing I can do about it. The bumping of the low of that bearish breaker and inversion fair value gap that you'll have on your chart drawn from the 5-minute basis. This little shaded pink area is denoting where on a 30-second chart here's that 5-minute breaker. The market trades lower, and then we're bumping it right there on that candle. Now, right at that candle at 3:07 and 30 seconds, what's actually occurring there? The market leaves that 5-minute breaker and it bumps into the inversion fair value gap and the 5-minute breaker right on that candle. And more specifically, it's going right into the gap between this candle's low and this candle's high right there. That right there is your London session ICT bearish silver bullet. It's going to fucking be there every day. If you don't know how to read price, if you don't know where it's going to go, if you don't know how to read the tape, this is reading the tape, anticipating where it's going to go. Fucking level 2 data, your order book bullshit, has absolutely no rhyme or reason why price is going to go there. That's spoofing. You can fake all that stuff. You can't fake or spoof the open, high, low, and close of these candles as they're forming. You can't spoof reading actual real-time price action. You can't spoof that. You can do it incorrectly. But once you understand what you're looking for, you're anticipating these things. Once the market's likely to keep going lower, that means you're in sell-side delivery. It means the market's going to go lower to take stops below old lows or reach into an inefficiency below the market price. That means some kind of fair value gap below market price. Where was that at this point right here? Well, we can use the 5-minute fair value gap. So if we were anticipating that level, don't worry, I'll show you what all this is here in a second. But if we're looking for an entry here for the silver bullet, and we're looking for it to trade down into sell side, this red level here is the sell side liquidity pool below the relative equal lows on this level here. That's this red level here. So if we go back into the 30-second chart, and we're trading in this level here, inside the silver bullet, right there. But ICT, I don't have the access to 30-second charts. Get it, because you're going to miss some of the silver bullets if you don't. Okay, because all I'm looking for is that small little separation where there's an actual inefficiency. And I'm going to tell you exactly what's going on right now. At that moment, right in here, as soon as price trades to this candle's high, and as long as the market is above half of this candle's body, which is mean threshold, algorithms, high frequency trading algorithms, are firing in short orders constantly. Boom, 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 as fast as you can get them in there. As fast as the market will absorb it and take them in, high frequency trading algorithms are selling the fuck out of that. And it slows down when it gets to about right there. That selling by the algorithms is not pushing price down. Because if it was, it wouldn't trade up while it was doing it. The market goes up to offer the entity that I collectively refer to as smart money. You're not going to see them. They're not writing books out there. They're not going out there and making courses for you. Okay? This is the truth behind the marketplace. You've watched me do this live in front of you. You've watched me trade with real accounts, live money. It's reality, folks. You won't believe it until you see it yourself. And once you experience it and you start seeing it repeat, doing back testing, doing what I'm showing you right here, this is back testing. This is my way of back testing, looking for these signatures in price action, collecting the data, and then taking a snapshot of the charts like this in like small little areas over here or over here. You write out your observations and you record as if you anticipated that happening real time. That's positive self-talk. What you're doing is you're creating pseudo experience, which is far better than using something like a market replay report, which is absolutely horseshit. That's not real results. This is where you're going into the chart and you're specifically looking at an element of price delivery and you're internalizing it. You're recording it with an emotional stimuli that at the time when you're doing the back testing, you're talking in the chart like, or the annotations rather, like you really saw it happening. With the on a 1-minute chart, after the price starts its run, again, here's that sell side delivery, or sell side liquidity rather, I'm sorry. Get a little animated here. I don't need coffee, brother. Chemical imbalances do it for me. Sell side liquidity, relative equal lows, and the silver bullet here. So we're going to anticipate price drawing initial to this one, and over here. Here we accelerate to dig into this sell side liquidity pool there. So we create a sell side imbalance, buy side inefficiency, a SIBI. Remember, if it's a fair value gap, if it's a down close candle, that means it's a SIBI. That means we anticipate price at a later time, at some time, it's going to reach back up into it with the expectation that it should offer new opportunities to do what? Accumulate new shorts. If we're bearish, would we want to see this entire range completely repriced too on the upside of it? In other words, overlapped with movement up. No, we don't want to see that. Why? Because if it starts keeping these things open, remember I was teaching you about the 5-minute fair value gap here where it was left open. I would want to see that stay open on above this high here, not completely overlap that candle. The same idea there is what we would expect here. We want to see the upper portion of an inefficiency stay open. So every single time an inefficiency manifests itself in price, if I'm bearish, I am actively interested in seeing if it stays open. The upper half of it needs to stay open. As long as it's doing that, that gives it lots of room to keep going down. Why? Because it becomes a measuring gap. Breakaway gaps, measuring gaps, and then you can have exhaustion gaps. So this inefficiency, we would want to see the upper half of that stay open. Why? Well, several factors. Number one, it would invite the likelihood of continuation going lower, which we haven't even traded to the sell side here, which is that red level. So the stops or sell stops below that red level haven't even been engaged yet when this was formed there. We have an old low here. So the likelihood of it going up and completely overlapping this one down closed candle and still going lower, I don't like that. So if I was in a trade and I saw this going up to that point there, it would be extremely critical for it to immediately and aggressively reject that and go a lot harder lower. If it was meandering around and not willing to go aggressively lower after going into the high end of this level here, then I would kill the trade. I would collapse it and just be done, because to hold on to a trade like that in an area where I know the likelihood or probabilities would be shifted against me, then I'm going to start spending mental capital. Even if I have open profits in the trade that have not been realized yet, haven't closed the trade, I'm going to start spending mental capital, meaning I'm going to be worrying and stressing about something that I don't ultimately have any control over. And then I'll start wrestling with the idea, if I get out, it might move in my favor and I'll regret that. If I stay in, it's going to eat up more of my profits. So as soon as you start getting to that point in your trade, are you in control of your trade anymore? No. So you just abandon it, abort it, take your profit, whatever it is, and move to the next opportunity. If it goes against you and would have stopped you out, wonderful, you did the right thing. If it moves in your favor and goes to your target, wonderful. That means your model was correct and you managed yourself correctly. You have to manage you. Nobody's going to do it for you. I'm not going to be in the room tapping you on the shoulder. Hey, you know you shouldn't do that. You have to develop these skill sets on your own. So if it's not going to go in the upper portion of this gap and trade higher and close it in or reprice to it, we want to see the halfway point or less be sensitive. And here's 25% of this SIBI. I'll show you what that means. From this candle's low to this candle's high, 50% level there, and then lower quadrant or quarter of this range. You can see it here. 0.25 is the measurement from this candle's low to that candle's high. So if I'm bearish, I want to see the market respond aggressively and sell off at either the quarter or the halfway point and not trade up into here. Okay? Because the algorithm, if it does these things like that, that's like a warning sign for smart money to just be careful, don't add new positions. That's what it is, folks. I mean, it sounds like conspiracy theory, sounds like contrived Tom Clancy kind of shit, but that's just the way it is. Okay? It is the way it is. And you tell me, what's the price level here on this high, on that candle? You're going to be looking at it up here, okay? This upper left-hand corner. What's the high of that candle right there? 15,652.75. What's the quarter level? 15,652.75. Find that in your fucking supply and demand, okay? Find that in Wyckoff. So the market goes up into that range. We want to see it stay open. If it closes, then you have to deal with it differently. But every inefficiency, I'm trying to anticipate them staying open. If I'm bearish, I want to see the upper half stay open. If I'm bullish, I want to see the lower half stay open. They may come back down and reprice. If it comes down and reprices, and it hasn't, like for instance, if it hasn't gone below the sell side here, this is important stuff. These are the things that you need to be listening to and why these fucking live streams and videos are beneficial to you. This is the stuff you don't want to hear and see other people complaining, but this is the stuff that's going to make you fucking money. This is going to be the thing that helps you keep your money. If this would have repriced to the upper end of that candle's low, if it would have done that, and it did not go below this red level, which is the sell side liquidity pool on the 5-minute chart, that means that I would still be willing to hold the trade, but it needs to start dropping aggressively once it gets there. It cannot wait around and spend time like it was doing here consolidating, and then goes to the lower quadrant of that sell side imbalance, buy side efficiency, then dropping. I don't want to see that once it does this, goes back up again. If it would have done that, I would have held the trade if it would have done that, but it would have been a time stop added to it. That means as soon as it touched this candle's low, it's got 2 fucking minutes to get in my favor and outside of that range here. If it doesn't do it, I'm taking half the trade off or all of it. Because the likelihood is they may not come back down here to take that sell side until New York. Big paradigm shift, what I just gave you there. For the new folks, it's going to feel like it was mumbo jumbo and means nothing. And it's because you're still too new to know what's good information. But that stuff is algorithmic. That is real mechanics behind how you manage a trade, how you manage risk, how do you anticipate and forecast future price delivery, and how you manage yourself psychologically, emotionally. All these things are predetermined protocols. I know exactly what I'm doing, how I'm going to do it, how I'm going to behave. I'm not surprised by price action. I'm not worried about missing a move. None of those things, because this is how I internalize price. These are the benefits of reading and learning what it is I'm teaching you. But you can't just watch this video, this live stream with me live right here in front of everybody live. You can't just watch this one time and walk away with, yeah, I know exactly what he's talking about. You have to go into your charts and build a library of these examples in specific times. So anyway, if we're anticipating that price run from up here down into, we'll just use the easiest one, which is the sell side liquidity pool here. So from premium to discount, we have a inefficiency here. If we were framing that red line to the mean threshold of the 15-minute bearish order block, if that was the context we were framing for premium to discount, could we take a short in here or add to it? Trick question. I'll give you a second while I get a drink real quick. If we take the fib, and for the folks that have been with me for a while, you already know this, my students. Okay, here's the halfway point or equilibrium between that premium to discount range. High, the target, which is this, what kind of range is this? It's an implied dealing range. That means it's not been delivered yet. Up from here, we anticipate and we're expecting price to draw to this level here and lower. So that is a implied dealing range. When the market starts booking price and we get this big run here, does this drop or inefficiency, sell side imbalance, buy side inefficiency, does that occur above or below equilibrium of that implied dealing range? Meaning, is it above or below the 50% level? It's below. So while we are willing to observe and anticipate price being sensitive at the 25% to 50% level, we can't take a new position. We can't add to a pyramid position. We can't do that here. This is just an observation level to make sure everything is calibrated in our favor still, and we're just going to ride the trade out. If this inefficiency would have been at or above halfway point, that's where I do my pyramiding. Once we get below the halfway point, the probabilities shift in the manner that I'm not willing to assume the risk, because if I start building more positions down here, we've already touched the level and it could come back to that later on and it could have a deep retracement. And we also have levels like the new day opening gap low that I would have all that new position sitting in drawdown, which would erode into open existing unrealized profits. So when I'm pyramiding, there's a context and a protocol in which I have to adhere to. And if I'm trading within a preconceived idea that we're going lower, I'm not just randomly picking something. I know what range I'm in. And this range is the range that we would use initially. If we are creating inefficiencies in here or order blocks, something like that, I won't use that as a new entry for adding to the existing short position. It has to be in the upper half. It has to be in the premium, which is why I taught that in my core content.